Hey everyone, welcome back to another episode of the American Finances podcast. We've got a CPA and a CFA talking about anything to do with your finances and how you can get ahead, what you should make sure that you're staying in tune to, and just general things. But like always, this is not financial advice, so make sure to do your own research. But these are just some educational topics that we're discussing for your benefit. So starting off with, we've got some major news with the Iran war. I mean, this has been a huge undertaking that people, I think, at first thought wasn't going to be anything super serious, and now has turned into a full-fledged kind of global-ish conflict. I mean, it's not like a world war or anything, but Iran's like targeting a lot of side countries too nearby. Oil prices and brigades are happening, and the U.S. is sending in a lot of troops to fight this. I even know some people close to me have had military members that they know actually people from their troops get sent over there. So that's a huge escalation, especially when you start hearing about people that you know that could be sent over there to fight. And that has widespread implications for just everything. I mean, from gas prices to commodities and things like that. And I guess first things first, I've been seeing a lot of flights getting a lot of more expensive in the past like few weeks. I mean, prices to anywhere, like even just Florida and stuff, have gone from say like $200 to now 300 plus, and I think a lot of that has to do with the fuel prices going up.
Yeah, exactly. And Iran sits close to the Strait of Hormuz, and with 20% of global oil flows coming through that area, um, we know that we're going to see a change in the price of oil. And oil is really the core of the entire global supply chain. We need oil to pretty much do anything, to pretty much create consumer discretionary spending, and to even like medicine. Somewhere down the line oil is used, and firsthand we're seeing the impact of these increased prices of Brent crude oil and other oil equivalents in our pump. When we go to the pump, we're seeing prices are 30 to 40% higher than what we're normally seeing, and that's going to trickle down to airplanes, and not only having trouble going through the TSA line, but then you're gonna have to pay a premium to actually have those same flights because the gas to fuel the plane is costing more. So this is really something at the core of our economy that's impacting almost every sector.
Yeah, the TSA lines I think are going to get better because Trump signed an executive order to fund them, but I don't know how long that lasts or how permanent that will be, but maybe it'll just help until Congress passes a more solidified measure to help getting them paid. I think it's ridiculous that they're not getting paid. I mean, TSA I would say is pretty essential. I mean, lots of people, including politicians, fly everywhere all the time. So the fact that they're not getting paid and then now not showing up for work, which makes sense because why would you show up for work if you're not getting paid? But apparently they're going to get paid soon, so maybe the lines will get better and you won't have to wait an hour plus extra that you wouldn't normally have waited. But yeah, those flights are getting pretty expensive.
Yeah, and I definitely see TSA as part of the critical infrastructure spending that's necessary to keep America, on track, and keep America, safe. If you think about this war with Iran and certain bad actors that might come to the U.S. or have attacks against the U.S. As as retaliation, I think the first thing that we would want to do is protect the front line and protect um, airplane travel and the airspace in general. So to think of that some of these TSA agents hadn't have an income since the second week of February. I just think that that is something that I can't even fathom. Not going more than a month. It's just been a month and a half now without pay is not something that most Americans can do.
Yeah, exactly. A lot of Americans live paycheck to paycheck, and then if they don't have any emergency savings, like we try to recommend people save up a few months of emergency savings, then you're going to be taking out a lot of credit card debt to pay for things, and that is not ideal.
Yeah, hopefully, they can get that funding in there quickly, and and potentially have back pay because they've been working. It's not like if they haven't. The ones, I traveled last week to Florida, and there are people there. I mean, it's not like if the entire workforce has quit. So hopefully they can get the pay that they deserve, and even compensated up to a bit more, because it's challenging. They're going to have to take out debt, as you said, and that debt's going to have interest, and it's not their fault that they're having to do that. So hopefully proper accommodations can be made for that sector.
Yeah, and just like we mentioned on a podcast a little while ago, the I think it's the Chase Slate card has 0% interest for 24 months or 22 months or something. So definitely look into those 0% APR kind of trial run periods for credit cards if that's something that they need or that's something that you need for a period of time in your life.
Yeah, thinking back to that, that would be crucial for someone who obviously doesn't have the savings to accommodate not being paid for that period of time, and then also allow them to take on debt right now and then potentially pay that off when the back pay hits their wallet. That would be something that is definitely helpful if it's 0% interest.
Yeah, I saw too that I think on CNBC they were interviewing someone and she was saying how gas prices are actually on, I think, about a 1 month or month and a half lag. So we wouldn't really see prices going up immediately, but we definitely would see it going up in the next like coming weeks. But yeah, gas prices, I mean, they're closing in at $4 around us and they used to be what, two? I swear there was like two at some point. Like fairly recently. Like I thought it was maybe 230 or 250 and now they're closing on $4 a gallon. So I think my recent tank fill up was closer to like over like $60 compared to maybe 45 or something. You're muted, just so you know.
Oh, thanks. Yeah, to fill up my tank, it's normally around 60. But this week it was $80 to get a full fill up. So it's getting up there. And it's interesting to think that this all only started a couple of weeks ago. We're not really even feeling the full effects of the gas price increase as yet. This is really just speculation as to where we're going to land at the end of the day from an income statement perspective. So we're really going to start feeling the effects of this war if it's prolonged. Going on into Q2 and Q3, and then finally from like a company standpoint, we're hearing earnings estimates are going to see a significant impact in Q4. When this oil price trickles down and impacts the bottom line. So it's something that we definitely need to keep an eye on and pay attention as the market moves.
Yeah, what do you think else? Because just like you said, oil pretty much funds the whole global economy. So if things are more expensive for oil, I mean, things are going to be tougher to get to. Like shipping container wise, it's going to cost more to ship ships. Having plane flights carry items throughout countries is going to be more expensive. So just everything that you're paying for is slowly going to go up in cost for things like clothes and even probably food, just trucking it across country and things like that. They're all going to go up eventually. And hopefully it's just not as bad as it could be. Because, I mean, the U.S. is trying their best to output more oil that they can, but they have only a certain amount of power before they need that Middle East oil.
Yeah, I definitely think it's going to hurt us. Like no matter what, we're going to see inflation creep through in almost all the sectors. I would say like if you're thinking about positioning your portfolio to fall upon more safe haven assets, I think that's ideally what you want to do. I know we've been seeing different things happen with the correlation between equity and fixed income assets. So fixed income might not necessarily be the safe haven that we're accustomed to. We might actually see yields increase, rather than the typical flight to quality and yields decreasing. But it's important to distinguish in your portfolio between the companies that have consumer discretionary products versus ones that are critical for individuals. So you're going to think about your healthcare, think about spend that people cannot negotiate. When things like this happen, people travel less, people go on less vacations, and that's why you're going to see more hits in industries like the travel industry. So I think Carnival's down, Norwegian Cruise Line is down, and even thinking about gas prices increasing, DoorDash and Uber significantly decreased. So if you're thinking about positioning your portfolio and sort of hedging against this war, you can position yourself into more I guess inelastic spending that consumers are going to be looking at.
Yeah, speaking of cruises, you know how many gallons of oil that they use per day on a cruise?
I don't know. What is it?
It's about 80 to 100,000 gallons a day.
Wow, 1,000? That's
Yeah,
insane. Yeah,
imagine using 100,000 gallons.
that's ridiculous. Yeah. And to that point, it's not only because we saw something similar in COVID where we had um, a large decline in spend in most of the travel industry market wide. We saw Carnival was down, we saw Norwegian was down, but that was because people were traveling less, not necessarily because their gas prices significantly increased. We know that around COVID era, gas prices decreased significantly because people weren't going anywhere. But this is going to be sort of a two-edged sword that's going to hurt them both ways. Not only are they going to have increased costs because of having higher oil prices, higher gas prices, but people are not going to travel as much because you're going to see inflation creep through, and people are going to cut back on vacations, and it's going to be expensive to even fly over to a port that someone would want to leave to. So it's going to be something that's going to impact that industry more so than any other industry in the market. So if you're in Carnival, if you're in Norwegian, you're going to want to pay attention to when this war is over and when you can start seeing relief.
Yeah, so speaking of those stocks being down, the market as a whole last week has just plummeted. I mean, not plummeted, but it's gone down significantly. I mean, a lot of names are down, even in like the double digit percentages. So, do you think it's time to buy?
Definitely. I repositioned my portfolio last week and I significantly bought heavily into the S&P 500. And I'm going to look to buy either a couple of single names next week or buy more into the market next week as well.
So, I guess so you bought more of just the market in general. Do you think that's what's to buy right now, or do you think looking for those individual names that have decreased even more than the overall market? Because I'm kind of torn on one or the other.
I definitely think individual names might be the way to go, but I personally don't have a ton of time to do research. And although I do have access to a bit of market research and I can put that into play, I really like focusing on the products that I'm investing in, the companies that I'm investing in. So it's going to take me some time to have that conviction to want to pour into a stock uh, at that first line level.
But even if it's just like a Microsoft or a Google or something like that.
Yeah, I definitely think those are solid buys, but I think where I'm torn is I think there's definitely more alpha that you can find in the market with what's going on. I think if I was to spend some time, maybe 3-4 hours doing a bit of research, I could see myself, investing in a single name out there that should return, a bit higher than Google or Microsoft right now, because those are obviously just temporary decreases, nothing structural, and I think that across the board, even like Nvidia, I do think that's going to be a structural decrease. I just want to do a bit more into their bottom line. What are we going to see? How are we going to see consumers react? If they increase their prices, and when are they actually going to have to increase their prices? How diversified is their global supply chain? That's sort of the approach that I like to take before throwing money behind a single name.
Gotcha. Yeah, because I mean, Microsoft's down from like 550 almost.
Wow.
So
Wow.
they're down $200 almost a share. And in the last 6 months, they're down $160 or 30%. I mean, 30% decline in Microsoft, that's pretty large. I mean, I think Nvidia is only down like maybe 10, 11% or something. So they're
Yeah.
actually not down but Microsoft seems like a definite buy. Microsoft always seems like it just keeps going up slowly but surely, but it just kind of like rides these waves of, oh, I'm gonna go up for a while, now I'm gonna go down for a little bit, I'm gonna go up for a bit, now I'm gonna go back down for a bit, and it somehow just keeps going up over the long term. I don't know how, but yeah, I don't know. Microsoft seems enticing to me. Even like honestly, Apple seems pretty enticing to me. It's also not down that much over the past year, even this year. It's only about 8% this year, down from like 184 to 250. But I agree, like there are definitely some names that are beaten down more that you could look through, but the market's a great option for those that don't want to do a ton of research, don't have a time, or don't want to buy into something and then have to sell it within like a certain amount of time and have those taxable gains or even just manage positions in their Roth too much. And the S&P is great to just buy and hold for long term, and you can get a great discount on it right now.
Yeah, and like another reason why I don't want to throw my money behind the single names is going through all that regulatory um, red tape that I need to do, like having approvals between approvals for my trades, and then having the holding requirement. I do like the idea of options. We're in a period of heightened volatility, so there is also going to be that opportunity to not only hedge your bets but also capitalize on that elevated volatility, and then enter into positions where you can short the heightened volatility that we see in today's market. So that is also something that I've been considering, but everything's still up in the air. I'm definitely going to do something next week when the market's open.
Yeah, that reminded me. I think someone I saw online, some Reddit post was like, "Oh, you can buy a $500 Microsoft call for only XYZ," and it's like if it just returns to the levels that it was at, you'd make so much right now. But the issue with the Microsoft calls is Microsoft's a three to it's a $350 stock right now, which means if you buy one contract, you're paying, what would that be, like $5,000 or $4,000 on that? So that's a pretty expensive call.
Yeah, yeah. With heightened volatility, all of these options are going to increase in price, but I mean, it might be worth it. It might be you might get the returns that you need. And to what you're saying, if you have you know enough time till expiration, you don't need to necessarily meet that price point. It only needs to go up a bit for you to for that to return something reasonable. So it might be something to look into.
Yeah, it's crazy. I mean, calls options are so tricky because it's just like, yeah, you could be right, but if you're wrong timing wise, then you're wrong. And like you can buy a December 2028 $500 call on Microsoft for $4,000 ish, which is like $1,000 discount on what buying 100 shares would normally be, right? Or no. Um no, 500 shares or 100 shares of Microsoft would be $50,000, right? Yeah.
Yeah, I think so. And that reminds me, I think we were talking, last week about tax loss harvesting. Some people have, you know, unfortunately purchased their stocks early on, and I guess before this heightened level of uncertainty in the market and before the stock started to plummet. And if you have losses that you might want to harvest, you might want to sell them now and rotate into a similar stock and just hold that tax loss until the end of the year, where you can apply it to your income or to another gain that you take in a different stock. You can go ahead and do that. That might be something to look into. Um, and if you can, any way you can lower your tax bill, honestly, is something positive that I'd look into. Some people are paying taxes right now, and they're unfortunately seeing higher prices at the pump. Eventually going to see higher prices on their grocery bill, and also having to pay tax on top of that is something that nobody's happy about.
Yep, yeah, I've got a few $100 tax bill to pay. I think it comes out of my account Monday or tomorrow. Um, yeah, not huge, but not great. But yeah, I mean, if you could buy a $500 call for only 4 grand instead of 50 grand, you still need the stock to return 50% by that date to break even. And so I feel like that's kind of like a tough thing to realize, but or to conceptualize because you don't need the stock to get to $500 for you to make money. But if that stock doesn't get to $500 probably by January of 2028, then your call is gonna like start going underwater just because of theta decay. Like it's gonna start eating away. It's not gonna be moving up as quickly. So then your call is just gonna slowly lose value unless it gets closer and closer to that strike. But that's like the hardest part about managing those long dated expirations for options that I found. Like early on in the days of having some of these leaps, I bought I think on like Corsair or something, the gaming company. The
Yep. Yep.
Yeah. So on Corsair, and at first, like the first few months, like I was up a few $1,000s because of how well the stock did. I think it was like for some reason kind of like a meme stock too at the time. Like this was back when that was like running, which I didn't really get completely why, just mainly because the products that Corsair owns are actually good and people like using them and they have high quality behind them. But I think like maybe fundamentally stock wise, people didn't really think they were worth as much as they were on paper. But anyways, so I was up a lot of money on them, but I was like, okay, I have this stock expiring like next January though. I've got plenty of time. I'm just gonna wait because I expect it to keep going up. I like the stock. And then like by that time, I guess the hype died off and people were like, actually, no, this isn't worth that much. Let's bring it down. And then obviously it it kept going down, down, down from there, and then you lose all your leap option. So it's like, yeah, you were right for a little bit, but then when are you gonna sell it? Because if are you gonna sell it when you're up some, or are you gonna sell it when it gets closer to the time? It's kind of hard to manage the position later because you don't know, like, say Microsoft has this like revitalizing moment where they go to 480 a share and you're like, yeah, they're still $100 off their 52-week high. I think it's gonna go closer to 550 by the time this call expires. Well, you're probably up like 40%. Do you sell it? You still have a year till expiration. Do you sell it? And if you don't, then you could be losing all of that money that you didn't take, or you could sell it and have it and then allocate it into other things, but it's kind of like it's a really tough place to be in, I think.
Yeah, it's definitely something that is tricky to get right, and that's the rough thing about options trading. You have to, not only understand the movement of the stocks, but understanding the timing as well. Like, um, you're not only bound to a certain strike price, but then you're also bound to a certain, time to expiration, and understanding, theta and how that's going to impact your return is crucial before you enter into that position.
Yep, exactly. It's not super easy. That's why a lot of people say stay away from the options. I think honestly, the options trades to do, they're not as glamorous, but it would be selling calls in a market like this where you just don't know when the market's going to turn around. So you just are going to collect a little bit of premium as it keeps falling. And then selling puts as it's kind of starting to recover when you have stocks that you're like, I wouldn't mind owning this if it falls more. If it doesn't fall, then I'll just take the premium. And I honestly feel like the selling the puts and calls are the way to go. It's just easier to manage because then when it moves into any sort of profit margin that you're okay with and you just want to roll it and go to the next strike, then you can, and it's pretty easy. And you're also not expecting to make a lot of money because you generally sell it for say like a few $100s and then you're like, "Oh, I've made $150 off this. Yeah, why not take it and roll it out to the next expiration?" And then you keep doing that and that's easier to manage compared to like buying a put and a call. You see that fluctuate so much of like, oh, I'm up 10, oh, I'm down 15, oh, I'm up 35 now. And you're kind of like, oh, do I want to wait for more? Do I want to wait for less? Do I want in and out of this position more or often? Or like, and it's kind of, I feel like there's more hoping that it goes up because there's an unlimited potential when you buy options compared to when you sell. You can only gain a certain amount from there. So you're kind of like And what's another $50? Let's just close the position and take our earnings that we've already made. Do you know what I'm saying, or does that sound crazy?
No, yeah, that definitely makes sense, and I think even in today's market with the volatility that we're seeing, um, if you want to do both, like sell a call and sell a put at the same time, enter into a straddle strategy is something that is going to make you money because volatility isn't going to stay high forever, right? We're going to move to a period where things die down, things settle down, and if you can make money off, volatility decreasing, that's definitely an options play that you can use in your toolkit as well.
Yeah, so what would you say is a low volatility? Like what's your number for low volatility? Do you have one?
I'd say like when the VIX is hovering in like the low teens, probably what I would say is a low volatility play. Um, and right now, I think last time I looked, we were at 28 or something like that. So we're definitely in a period of high volatility. So if you wanted to, buy a call, buy a put at the same strike, same time to expiration, what that lets you do is you're going to have both sides sort of cancel out each other. So regardless of where the stock moves, once volatility falls in the stock, you're going to make money off of that. Because you're selling the call, selling the put at a period of high volatility where people want to buy that level of insurance or want to participate in the upside more than they would in a period of tranquility within the market.
So you go off of the VIX for your volatility measures. You don't go off of like the individual securities volatility.
Yeah, I mean you can definitely use both. But most of my plays, if I were to do it, would be in the market. But you can definitely do straddle strategy on individual names, and it might even be better for individual names. You definitely return a higher return on things like even as we were talking about before. If you did a straddle on Microsoft or Nvidia, really any of these tech names, you would be in the green.
Yeah, I usually look at the individual securities volatility measure, and I feel like I usually look at like if it's over 50%, then I think it's high. If it's under 50, then I feel like it's not generally high. But I also feel like the market as a whole, you got to be only playing with a few percentage points, right? With volatility wise, like not looking at the VIX, but like the volatility, like the
Like the
IV
volatility of the
on,
okay, yeah,
yeah.
on like the S&P 500. Yeah, I mean it doesn't really take much for it to be high because the market only goes up, a couple of basis points each day. Um, but if you were to, so I guess the return is going to be muted compared to single names. Um, and it might make sense to definitely dive into single names and do the strategy there because you're going to have higher volatility and when that volatility drops back down to norms, um, you can then exit out those option strategies and um, you'd be in the green.
Yeah, I think yeah, the biggest question in the stock world is just when do you take your gains?
Yeah, it's in.
You gotta have those numbers in mind, or you just gotta play the market as a whole.
Yeah, and it definitely takes extremely disciplined individuals to not let your winners run and to know hey, like although I said or although and when entering into the strategy I said I'm comfortable with this return even though the stock is shooting up 10-15%, I'm going to be disciplined and take my wins when I can. So it's definitely something that's difficult to get accurate.
Yep, because yeah, it's always easy to be like, oh, I'll cut this when I make 10%. But then if it blows past 10 to like 40, are you gonna say I'm done? Or are you gonna take another, maybe it could go up another 20? I don't know. And then same way the opposite way. Say you say, oh, I'll cut this when it reaches 10. It gets to 8. You're like, it's only at 8. I said I'd take it at 10, so I'm not going to take it. And then it goes down like 40. Are you going to cut then? Or are you going to wait till it gets back up to 0 or something? So, yeah, definitely the discipline required is so high. I remember I've been I've like experimented with selling like iron condors in the market, and yeah, those like most of the time, like the market will stay within a range and you'll make money. It's not like a ton of money, but you'll make money on that on like iron condors each day. But then like if you watch that throughout the day, you will literally give yourself gray hairs. Because you'll be like, all right, we're in the money, making $200 off of this. Okay, out of the money, I'm losing 500. Then you're like, hopefully the market comes back and pulls a little bit. And then you're like, all right, we're in the money, $20. Do I cut it now? We were down 500. We were up 300. Now I'm up $20. Do I cut it now and be done with it? And then somehow by the end of the day, you're like watching at like 3:50. You're watching like minute by minute until 4 o'clock hits and the market closes, and you're like, and yep, got it. No problem. Not even worried. It's
Yeah.
crazy.
Yeah, those types of strategies will definitely make you pull your hair out. So you gotta be disciplined, stay within your your risk appetite, and not go too crazy, and you'll be fine. But if you do, like, hopefully you're in the green.
Yeah. And plus, like, a lot of people don't understand that when you run plays like that, your brokerage or like yeah, like your brokerage doesn't settle them all in the same way. So like you would see, oh, you owe $500,000 worth of stock on this position, and it's like, no, I really don't because I have the covered like call essentially for that sold call or whatever. I bought the call for the sold call or bought the put for the sold put or whatever, and they just haven't like processed through both transactions yet. So you'll see like huge numbers of like, oh, you're down $2 million. Oh, never mind, we found $2 million in your account. Like it's I don't know why the brokerages are so bad at that sometimes, but sometimes it's pretty bad like that. I've got a few screenshot, or not screenshots, but I've had a few statements on my account that it's like, oh, made this play and had to go under into like margin debit of $2 million, and then the next line will be like, oh, $2 million added to your account to cover this position, and it's like my account has $2,000 in it. You're like, it doesn't have any sort of money to pay for this, but luckily, because of how options work, I didn't need to have that much money in there.
Yeah, that's definitely something that would scare the average investor if they don't know that they're covered.
All right, well, I guess to wrap it up, quick question. Do you think like a question for the takeaway? So, quarterly earnings, there's been some talk about the companies shouldn't have to do them anymore. We're kind of coming up on another earnings season here. I think some big tech comes up this week with their earnings. I think banks might be in a week or two, but what do you think it could mean if quarterly earnings do get canceled? So say, okay, you only have to do two earnings a year. Choose when you guys want to do them, maybe at year end and June or something, who knows, but do you think companies will get rid of their quarterly earnings and not even report anything and just do what's federally mandated? Or do you think every company will just maintain status quo, but they'll kind of put less emphasis on the quarterly earnings, less regulatory scrutiny, so they won't try as hard? They'll kind of pare it back some, but still come out with things for investors. What do you think, I guess, would be your opinion before we just sign off?
Yeah, so I think that this is something that has major impact to smaller companies in the market who do not necessarily have the infrastructure to produce reports quarterly that are meaningful, impactful, and complete. However, for some of these larger companies, if you think about like the Mag 7, large banks like JP Morgan, Wells Fargo, they're more than likely going to continue with their process of releasing reports every quarter. And the reason being is, if you think back to the market that we're in, and the lack of transparency that would affect individuals and their portfolios. Nobody's going to be happy if you hear, well, let's say Apple says, we're instead of hearing from us, hearing how we're doing, 4 times a year, we're going to cut that back to two. That doesn't instill confidence in their investors. And because we're moving down and cutting that in half from four to two, it's not like if we're increasing it from two to four, we're going to see investors be wary of companies that report less. And I mean that's common for really everything in life. Like if you have lower transparency in anything that you do, it's heightened risk. So with that heightened risk, you are going to be more wary of the position. I feel more comfortable investing in a stock that let's say that everything else equal. I'll feel comfortable investing in a stock that produces reports 4 times a year compared to two. And these larger companies already have the infrastructure built out, already have these accounting contracts or even in-house accountants that produce these SEC reports. So I don't see scaling back accountants is never a good thing for some of these major companies. For a smaller company, yes, and I think that may actually bolster some growth, not having to be held to that regulation every single quarter. They might be able to spend some of their money on R&D and it might build them a bit, but they're definitely going to switch to four if they get big enough. And that's something that we're probably going to see a common trend in the market going forward.
All right, interesting take. I feel like they might do a reduced earnings, but hard to say at this point because yeah, I think there's definitely some kind of scrutiny on, oh, you only came out with these numbers, or oh, why didn't you do more emphasis on this? And it could kind of shift investors' confidence in companies if they all of a sudden decided we're not going to share the full financial picture at this time, especially like this is like the one chance that they have to do it and they probably wouldn't want to do that. But we'll take it for next time, but thank you guys for listening in. And if you have any questions, comments, or things you wanted us to talk about on the next one, make sure to leave them below. This will be a YouTube exclusive podcast until more people want it elsewhere on other platforms. But thanks for joining, and we'll catch you in the next one.